Okay, well, greetings, class. This is actually going to be your first real theoretical model. So, pardon the glitchy screen. I'm using an old camera. But this model is actually your first theoretical model. We've worked with data, and just to kind of get a recap of what we've had so far from the data side, we've looked at GDP, we looked at prices with inflation, and we looked at unemployment. Okay, so this is what we've covered so far in the class. We've looked at this in a data sort of a way. Now, in a theoretical model, this is going to be a very quite abstract. So, just like any model, now think about a model airplane. Is it a real airplane? No, it's not. Is it, so a model by definition is an abstraction. A model is not real. These models do not fully encapsulate the full model for an economy. You cannot have a full model for an economy. Okay, it's you can make them more detailed and you can add more bells and whistles, but every model is going to be an abstraction. So the first thing I wanted to sort of cement when we're talking about something very abstract is what's real and what do we really observe. And so getting back to the data, what we're going to observe in this model is we're actually going to observe GDP and prices, and unemployment is not going to be directly observed, but more indirectly. But really, what we're going to be looking at are GDP and prices. Will be the things that we'll actually have that link directly from the model to the data. There's going to be a link here. Okay. And so we start off, actually, we can start off drawing our model. We'll draw it in two dimensions. We have two variables. So we can think of an X and a Y variable. And we'll just draw this in a two-dimensional space. Okay, and we'll put real GDP on this axis. And we'll put the price level on this axis. Okay, so if you give me a point in time, now remember, how does this data look? Remember when we looked at our data, we've got different dates. We can have GDP and prices for a given date. And then remember in the data project, you had many different values of GDP over many different dates. So one thing that's not in this model, not included, we'll write not included. Okay. One thing not included is going to be time. Okay, so we're not going to allow for multiple periods. In other words, what this model is it is a snapshot, just like a photograph, like a ching snapshot of the economy. And so for a given date, you can think about a snapshot as like for a specific date. We can have one GDP and one price level. That'll be a point somewhere. So a point in this space has an X value and a Y value. Here's my price, and here's I'll call it Y for my GDP. It's a price level for a certain date. Now, what we're modeling is, why is it that price level? Why is it that level of output? That's what we're trying to sort of explain. We're trying to explain this point, the current level of GDP and the current price level. And so this is where the theoretical model comes in. This is where the abstraction comes in. Is we say that this point, this price level, this GDP in a certain time period is the result of an interaction between two market forces. And we think of a market as an exchange between buyers and sellers. Okay, so we actually have sellers that are going to supply. So we have our supply curve, and we have consumers in the other side of the market that demand goods. Now, we might actually take a pause here and think I just drew two lines. Well, why did I draw them this way? I just drew an upward sloping supply curve, a downward sloping demand curve. Okay. I mean, I could have drawn any line I wanted. Why did I pick that? Why did I pick those shapes? Well, first off, um, I guess we'll have to explore this a little bit. Um, so just keeping that in mind, looking at this interaction between supply and demand, you see where supply equals demand, we're saying that these two market forces are equalizing, and there's forces and dynamics that cause these to equalize that we can get into. But it's this intersection between supply and demand, where supply equals demand, that we say the market clears. And it clears at a price, and it clears at a specific level of GDP. So it's this intersection, it's this equilibrium, it's where market clearing happens, right at this equilibrium. Um, and again, these lines that I'm drawing are not, they're not real in the sense that we're not observing these. We don't observe these lines in any data set. Okay, these are purely theoretical. What we do observe is this point. Okay, so just hopefully that's all clear. If I were to draw, if my supply and demand curve were over here, then we'd have a different price level and a different level of GDP. Okay, again, all we would observe is this point. And so what we're sort of enforcing is that all of the data that we observe in the real world for a specific moment in time is the result of this interaction that I've drawn. Okay, that's the thing we're actually imposing here. So a couple ideas real quick. Why did I draw a downward sloping? So why is, first off, why is demand is downward sloping, and we have two, supply is upward sloping. Why is that the case? Well, think about this. The demand, this actually, the downward sloping demand curve is, it comes from this thing called the law of demand. So think about, at higher prices, do people demand more or less? Well, look, when the price is high, the quantity demanded is relatively low. When the price is low, the quantity demanded is relatively high. So this is following this law of demand, which you think about, there's a lot of reasons for this. We'll get into this in microeconomics, but you have, as as prices fall, as you all know from your current study on prices, people become more rich in real terms. So because they become more rich, there's this sort of income effect. As you have more income, you demand more things, right? That's one explanation. There's multiples, but that's one. Why is supply upward sloping? Well, think about, when the prices are higher, firms are willing to supply more. That makes sense, right? And so there's some just general intuition. Again, we get into this more in microeconomics, but the point is that you really see is what we're trying to explain is this equilibrium. Um, now, I'm going to give you a couple elements here to this model. We have supply demand. Uh, I'm actually going to add on to this a little bit. What you need to know in order to understand these models is you need to know what each of the elements in this section are sort of representing. So what is actually demand? We're going to specify this. Demand is, this is going to be, I'll just draw an arrow. This is going to be C. So consumers demand things, right? Consumer, we have consumption. We have investment. In other words, there's the demand for capital goods. We have government spending. So the government demands things. And we have net exports, which means the world demands things. That's how our aggregate demand curve, these are all of the components that fit into our aggregate demand curve. Okay. And actually, we'll call this not just demand, we'll call this AD, aggregate demand. Because this is the macroeconomy. Aggregate means pulling everything together. And that's where you get this AD. And this is actually going to be aggregate supply, which is where you get the ASAD model. So we have consumption, investment, government spending, net exports, all filtering in to aggregate demand. And it's very important that you know each of these elements. Why? Because what we can do now, if we know these elements, right, we can actually see that that changes in any of these are going to have the effect of shifting the aggregate demand curve. So think about this. If there's a COVID lockdown, all of a sudden nobody wants to buy anything. Maybe or maybe people maybe it's people buy a lot. I don't know. You can argue about that. What was the effect on consumption? I mean, people were rushing in the stores trying to buy up everything before the pandemic, and then maybe there was a slowdown in demand, or maybe there's excess demand. I mean, you can always talk about these things. So let's look at it this way. What if let's say you're in a time period where consumption is really there's a lot of pressure for consumption to expand for whatever reason. You can think of whatever reason. How's that going to affect your aggregate demand curve? Well, consumption, anything affecting consumption that drives consumption upwards, anything that drives any of these variables upwards has the effect of shifting aggregate demand outward. Okay. And anything that obviously that does the opposite. So if you have anything that lowers any of these variables, consumption, investment, government spending, net exports, anything that lowers any of those pulls aggregate demand inward. And the important thing that you see here is what's the effect of this shift in aggregate demand on prices. Well, as aggregate demand expands, all things held constant, what happens to prices? Yeah, prices rise. You see, the new equilibrium would be here. So you'd have prices rise. If there's anything that decreases any of these elements, causing aggregate demand to fall, you see prices would fall. All things else held constant. So we'd end up down here. Versus if it shifts out, you'd end up at a price level maybe up here. Okay. So the interesting thing about this model is that every one of these variables establishes what's called a channel by which aggregate demand is influenced. And so we're going to explore these channels. Probably the one that I'm going to look at in a lot of detail is going to be the investment channel. Okay. So real quickly, just to build this out even a little further, investment. Let's look at investment. Investment channel. And I want you to remember what is influencing investment that we talked about. We talked about this a little bit prior, which is that one of the things that's changing also are interest rates. So interest rates. And this is probably one of the most fundamental relationships that you need to understand here in macroeconomics is this relationship between interest rates and investments. And so just to reiterate, and I'm not sure if you've heard this or not, I believe you have, but think about the case where interest rates rise. What do you think that's going to do to investment? And investment, what am I talking about with investment? I'm talking about real investment. Okay, this is the creation of capital. This is not buying a stock. This is not, you know, getting into financial markets of like, bonds or other kinds of instruments. This is investment. This is the creation of capital goods. Capital being things like plants, things like buildings, machineries, vehicles, furnitures, equipment, because we're talking about real production. And so investment is the creation of those capital goods. It's when somebody, an entrepreneur or a business owner, actually buys a new factory, expands their operations. They have to make real investments, just like we're making here at the university. The real investment is this new nursing building right up across the street. That's a real investment. Okay, that's what we're talking about. We're talking about the real economy, real things, the real creation of real capital and investment. So now, in that kind of mind, think about interest rates. If you thought about investment as being stocks, you might think, well, interest rates go up, so that means investments must go up, right? Because people get higher returns. Actually, that's not the case when we think about real investment and real capital creation. So think about the case of this new building here on Newberry campus. If interest rates are high, what happens to that project? Well, think about it. Okay, you're gonna have to borrow. So think about there's a cost maybe to get funds. Interest rates rise. You have to, you need to borrow some money to make some of these investments. And what do you have to pay? You have to pay an interest rate for that borrowed money. So when interest rates are higher, you're paying more money. You're paying more interest. It becomes more costly to take a loan. and so projects that, when you look at when you get into finance, you'll actually, look at the profitability of, or does an investment make sense? And there's going to be a rate of return that you would get from an investment that you can understand is maybe a rate of return on the investment. And then you also have to pay, costs of the capital, the lending and the interest rates. So when your rate of return is higher than your cost of capital, it makes some financial sense to possibly do that investment. But on the opposite case, when interest rates are higher, then a lot of projects that have, maybe lower internal rates of return, they just don't get funded. So higher interest rates raise the cost of borrowing and drive investment down. In other words, there's sort of an inverse relationship. Higher interest rates push investment down. Looking at this channel now you have all the Q. Now you have all the links. So say interest rates were to go up, right? What does this do? The channel this could act through. This could act through maybe a couple channels, but the main one we'll look at is investment. Interest rates go up, investment goes down, aggregate demand, and then this results in aggregate demand shifting leftward, causing price levels to fall, putting downward pressure on pricing. That's kind of the key that we're looking at here. Okay, so is that we can look at all of these different channels, and so that's the aggregate demand curve. We talked about one of the major channels, and let's see. As far as the aggregate supply goes, what I'm gonna tell you is just a very straightforward way to capture so many different categories of things. Is I want you to think about this as firm cost. In other words, things that make firm that supply type issues typically all revolve around cost. You can think about things that drive costs of business up, you can think about actually the supply curve shifting up, if that helps you, instead of left or right. I like to think about it that way. So costs get pushed up, things can cause costs to fall. You can even think about like the recent supply chain crunch that we've had, where it's been difficult to get things, right? You can think about those as even as costs. Become, I mean, you can really get, you can still get anything in the world if you're willing to pay enough money for it. It's just that the cost of getting things is now increased because a lot of things are not readily available. So if you want it, you're going to have to really pay a premium. It means the cost of getting a lot of things has actually gone up. There's a lot of ways to think about things that drive costs up. Um, those all fall into supply issues. And you can, again, think of costs shifting up, think of costs shifting down. Now, the interesting thing about um, supply shifts, I'll just redraw this. Oh, sorry, should go AS. So supply shift, if you have something that causes firm cost to shift up, say from AS1 to AS2, you notice that this directly increases prices. So the old equilibrium in here, after something that causes this firm cost to shift up, you have higher costs, resulting in higher prices. So that is, and again, and then you also see real GDP falls. Okay, things that cause cost of the cost of business to fall, the cost of operations to fall, drop supply downward or to the right. You can think about costs falling, and you see that results in lower market prices and higher quantities. Those relationships are very important. One thing I'll say, why are they important, is because when you think about a recession. So if I say there's a recession, now here's the thing that I would like you to do for a puzzle. I'd like you to think about a recession in which prices increase, and then also think about a recession that could result in prices falling. So two recessions. Recession. Now we haven't really defined a recession yet in this model, but what I'd like you to do, just to be a little bit more clear, is go ahead and start with a model. Go ahead and start with a model here in an equilibrium, and I'd like you just to think about, two cases where GDP is going to fall. So in both cases, GDP falls, and you can only shift one curve at a time. Okay, and there's only one shift that you can make. So in one case, what kind of a recession would we have? What kind of a shock or shift would it require for GDP to fall and prices to go up? And what kind of a shift would happen? What kind of a which one of these would have to shift in order for GDP to fall and prices to go down? And if you looked at prices going up and GDP falling, that is a negative supply shock, or something that causes prices to, or the cost of business to increase, right? Negative supply shock is going to fit this. So this is a supply shock, and something that's going to cause GDP to fall and prices to fall is going to be a negative demand shock. You see, prices fall, GDP falls. So this is a demand shock. A shock, which means an unexpected change in one of these variables, or an unexpected change in the supply side on firm costs, such as, for example, you know, our global supply chains breaking down as they had in the recent pandemic. That's a negative supply shock. Okay, so this model can characterize a lot of different scenarios. You can have cases where you have recessions with prices going up or prices going down. You can have expansionary periods in the economy. Again, with different types of price movements, just depending on what is exactly driving those changes, what channels are actually being operated upon. And I think that's the kind of interesting thing about this model is that it allows for a lot of different flexible outcomes. And one thing that we're going to do to use this model is we're going to look at the real world in different types of scenarios, and we're going to try to model it using our ASAD model. And what it's going to help you to do is, by the end of it, you should be able to look at things like the news and sort of just start to think about, what would be the effect of this news event on the macroeconomy, and start to make your own little predictions. Um, I do that all the time. I make little predictions about things all the time in the news. Now, the interesting thing is that, we live, so in these models, we're just shifting one thing, holding everything else constant. In the real world, everything's always changing. And so we start off with this really simple case where we're just changing one thing. And that helps us to just really clarify our minds about how channels work, how things all work, how they work, how the model works. Once you get this part down, you can start to sort of think about this equilibrium, um, as being affected by both supply and demand shocks simultaneously, and start to think, well, we've got some, if you had a negative demand shock, you also had some negative supply shocks. Okay, that means that it's actually pushing prices in two directions. And then you start to wonder, which one of these kind of effects are going to dominate. And that sometimes can take a little bit more, I guess more intuition to think about it. But just think about it like a tug of war. Who's going to win? And in fact, this equilibrium is being pulled by many of these different forces, all pulling. There's all different kinds of news events that are pulling. I mean, government's rolling out a big stimulus package. You've got interest rates rising. You've got different supply constraints out there in the world. There's actually a lot of things all happening simultaneously. And to really look forward and try to make predictions, it's really to just understand, which of those channels is really going to dominate. And that's how you can start to make forward-looking predictions using this model. And that's actually the purpose and the real value of having a theoretical model, is that the model is not real, and also the future is not real. The only thing we have real is actually the data and what we have. That's the thing that we actually have today, is like what's actually happening today. The rest is actually a fiction anyway. So it's nice to have a fictitious sort of tool to deal with a fictitious idea, which is the future. So that's sort of a theoretical idea, and this is economic theory. So it'll help us to make predictions, and I hope you found this part useful. We're going to explore, and there's actually another element that I want to bring in to this model that I'll do in the next video.